Hey guys, excited about today's episode because I have got one of the best lenders here in Dallas, Trey Belmore, on our call to discuss what's really a trending topic, and that is the 50-year mortgages that we've seen out there. It's one of the most common questions that I've been asked, and we're going to talk about it today. And so, who better than to talk about it than an actual lender who's been doing this and studies it? So, Trey, I'm excited to talk about this
Yeah,
subject and see
as well.
thoughts. And I think to kind of start with the 50 years, what are they? Why don't we just open up there? And I know that's kind of a simple question, but there are a lot of people who aren't living in this industry like you and I are.
Right. Yeah. Well, I appreciate you having me on. It's definitely been a very hot topic in the headlines right now, the 50-year mortgage. So yeah, appreciate you having me on to kind of go over the nuances and just get my thoughts. I've been doing it since in the industry since 2013, so I'm in my 12th year doing it. So I've gone through a couple different cycles now. I've gone through the COVID cycle, and now rates are still a bit higher and prices are still higher. So all of that's kind of come to a head, and now we're hearing how do we solve this, quote unquote, housing crisis, so to speak, in terms of prices still being high? And one way to do that is this whole idea of a 50-year mortgage. And 50-year mortgage is, pretty much exactly like it sounds. Just like a standard 30-year mortgage, except instead of paying it off in 30 years, it's extending it to 50 years. And literally the whole premise is it's pretty simple. Longer the loan term is, the lower the monthly payment. And so that means people can afford a higher price point in theory, at least. And that's kind of the basic principles around it, but it's no different than a 30-year mortgage, except you're, paying it off 20 years longer. So that's the very basic high level explanation of a 50-year mortgage.
Got it. So, in the current mortgage field, what is the most I guess why is it 50 that's trending? Because is 30 the most that there currently is? And
Yeah, that's a good question. I think the probably simple answer is that 50 is a nice round number. I mean, the 30-year mortgages was created in the late 40s, I believe, and then it got implemented, basically industry wide in the early 50s. So it's been going on for 70 plus years now. Uh, there's been other countries that have loan terms that go beyond 30 years, like Japan, I believe, have 100-year mortgages where, it's basically an heirloom where you pass it on to your family. It's literally a 100-year note. And so I don't know why exactly 50 years was chosen. I think it's a nice round number, and we'll talk about it more. But yeah, I think the other piece to it is that, a shorter term, like even going from a 30 to a 40-year, doesn't really have that big of an impact on a home buyer's affordability. Whereas going from 30 to 50, it does help make that payment come down, thus they can afford more. So 50 does give you some more breathing room, so to speak, and flexibility. But yeah, that's my initial thoughts. It's all obviously very, very new, and there's a lot. It's going to take a while for it to get implemented industry wide, but it could certainly, I'm sure it will shift and shape, change a little bit between now and when it actually goes into full practice.
yeah. So, I mean, in your opinion, and we'll hit on if they make sense for the people watching or not, but are these actually going to happen or is it just a rumor?
My personal belief is that so it's going to take a while for Fannie Mae and like FHA loans, which are like the two biggest, entities that back mortgages in the United States. It's going to take a while for that to go through all the iterations that are required to actually fully implement it. Cause, that requires investors getting on board, figuring out pricing. That's going to take a while. My belief is that if the 50-year mortgage just goes through, which I think it might, it will start in what we call the non-QM loan space. Are you familiar with non-QM loans at all? No, so non-QM loan stands for non-qualified mortgage,
Got
and
it. Yeah. Okay.
really all it is, just for people watching, is that it's loans that are not backed by institutions like Fannie Mae, Freddie Mac, FHA, VA for veterans. It's loans that aren't backed by them, and so they're typically more for your non-traditional clients, such as bank statement loans for self-employed clients. We can do DSCR loans in the non-QM space, which is debt service coverage ratio. It's loans for investors that all we look at is cash flow for the property. In the non-QM space, we do a lot of lending in that space for clients, and they already have products that are similar. Like we do a lot of interest-only loans for investors that are trying to optimize for cash flow in the short term, and they're not really worried about paying the loan down significantly and accruing equity over time. They just want to cash flow, and interest only loans can do that. Non-QM investors that already offer 40-year terms. And so we're not far off. I think it's probably going to start in that space. And then, as we kind of see how that goes and Fannie Mae and Freddie Mac and FHA figure out all the nuances of how it works on pricing and so forth, then it will get implemented. But that's going to be a while. I think it's very likely that it will start in the non-QM space, and then we'll slowly see it transition to the more traditional, conventional FHA loans in the future.
And so when you say a while, you're thinking, are we 1 to 2 years away from this?
Yeah, I mean, I would say that's a realistic timeline, 1 to 2 years away.
So
Yeah,
what would the benefit be to somebody to actually have a loan on a house for 50 years? Some people would probably never pay their home off, in my opinion. If you're buying,
yeah,
um, I don't know the average death rate of the U.S., but if you buy your first home in your 40s or 30s,
or
might
even
not be paid
50.
off before you pass away.
Right.
From my understanding, with 15-year loans versus or 20 years versus 30, you know, 30s are going to be higher interest rates,
Correct.
and 15 and 20 you're going to get lower interest rates.
Correct.
But even with a lower interest rate, with a 15-year, it's still often more expensive than a 30 with a higher interest rate. So I'm
Yeah.
curious to where the 50 would be longer
Yeah.
terms, but you have a higher interest rate most likely.
Correct. Yeah, and that's the trend. You hit it nail on the head. Yeah, shorter the term, lower the interest rate, and vice versa. This is going to be no different. The 50-year, if it does get implemented, will have a higher rate.
Mhm.
It will result in a lower payment. And I have a scenario I'm gonna run through at a certain point. I don't know if you want me to do that
Yeah,
now.
do it now. Yeah, absolutely.
Okay. Yeah. So I was looking at the numbers of, I just kinda used a standard first-time home buyer. Prices are obviously getting more expensive. So if we were to use just a, client, consumer borrowing a $400,000 loan, and I just wanted to compare it on a 10-year time period, so we're not gonna do the full 30 or 50-year term. Let's look at what this compares on a 10-year time horizon. So you're borrowing a $400,000 loan, comparing a 30-year fixed loan at 6% rate, and then a 50-year loan at a 6.5% rate, and just show you what that means in terms of the interest paid over 10 years. Then secondly, how much you're actually paying the loan down, because that's the other thing that a lot of people don't realize is that the 50-year loan, it's going to result in a lower payment, but not only are you going to pay a lot more interest over that 50 years or 30 years, but you're paying the loan down slower over time. So the loan of 400,000 over a 10-year period, you're going to be paying it down much slower than a 30-year or a 20-year or a 15-year note. So like here's some numbers here. So on a 30-year fixed loan versus a 50-year, interest paid over a 10-year period, you're paying 222,000 on a 30-year fixed loan, and you're paying 255,000 on a 50-year loan. So that's, what is that, $33,000 more in interest paid just over a 10-year period. And then the loan balance. So after a 10-year period, a 30-year fixed loan, you're going to have paid the loan down from 400,000 down to 334,000 over that 10-year period. Same scenario on a 50-year note. And in 10 years, you're only paying it down to $385,000. So over a 10-year period, you're paying your loan balance down $15,000, which is pretty
Yeah.
significant. You in the same exact two loan products, same scenarios, you're over a 10-year period, you're accruing, what is that, $51,000 in more equity on the 30-year note compared to a 50-year, which is significant.
So when you think about it like that, what it makes it hard to really justify doing a 50. I mean, only pay down your
Yeah.
only actually pay down your mortgage by 15 grand in 10 years is crazy, especially when
Yeah.
you're making two, 3,000, $4,000 payments
Right.
every month. I mean, what's the benefit of doing it? I guess just a lower
Yeah.
pay, but
Yeah, I mean, the way I see it is that, I mean, that this has been viewed as, and this is kind of the million-dollar question, is everyone trying to find the silver bullet of how do we solve this higher prices, the higher interest rates? I think you've seen it as well. It's deterring and discouraging a lot of first-time home buyers from getting out there in the market because, it's just scary to take on that high of a sales price and the rates are still, where they're at. And so, they're trying to solve for that. How do we solve for that? How do we get more home buyers into houses? And that's, what helps stimulate the economy. I'm thinking back, if we go back 30, 40, 50 years ago, it used to be a requirement that you had to have 20% down to buy a house. That's what showed the bank that you were a good credit risk. And you had to have 20% down to buy a house, which was obviously a huge hurdle for 99.9% of homeowners. Then mortgage insurance came in where you can now buy a house with 3% down, but in lieu, you pay mortgage insurance to, offset the risk for the lender. Well, at the time, I'm sure there was a lot of critics of that saying you're going to give loans with people only putting 3% down and, they're paying a lot higher interest, by paying the mortgage insurance, which is just a sunk cost. It's the cost of having a loan with less than 20% down. But it opened up the door to a lot more homeowners. Like, obviously there's tons of homeowners that don't put 20% down. It's not an exact parallel, but I think the 50-year loan, it's gonna be another tool in the tool belt for me. Like, it's not gonna be the silver bullet that's all of a sudden going to solve this quote unquote housing crisis, but it's gonna give me the ability to serve another swath of clients that otherwise couldn't have gotten to a home. And, for me, I see it as the ability of, I'm talking to a client and maybe they can't afford the dream house because they have a car loan that's gonna be paid off in 2 years. And that car payment is preventing them from getting a loan. Well, if I had a 50-year mortgage in my back pocket, maybe we could do that where we extend the term in the short term. That allows them to get into the house of their dreams, and then my whole thought is this: I don't see the 50-year loan ever being a long-term solution. I don't, just for all the reasons we talked about. The interest you pay over the life of it is astounding. The rate that you're paying the loan down is very slow, as we just illustrated. So I personally see the 50 years just being a tool to kind of bridge the gaps. Like that same scenario I just described, maybe the client utilizes a 50-year mortgage up front to get into the house of their dreams. Over the next 2 years, they pay off that car loan, rates come down, they earn more income. They now qualify for a 30-year fixed loan. Well, at that point in time, we can refinance and get them into a better product. And we do that today, even with the current environment. We do that all the time where someone starts with a 30-year and then we refinance them to a 20, 15-year term to, pay the loan off faster. So it's the same philosophy.
That's what I was gonna ask you, because I think that's one of the justifications for the 50 years. A lot of people are saying, well, you start your purchase with 50 and then you refi out of it at a
Yeah.
30 or a 15. Here's the question I've got is, that's what everybody says they'll do. Often, there's a study done that says whenever people buy a car or they buy a house and they initially say, I'm going to pay an extra 300 a month or whatever that is on the car, or the house. The study was done that
They
it's like
don't do that.
less than 80% of people, or I'm sorry, it's 80% of people don't actually do that. And
Yeah.
so
They figure out somewhere else to
let-
spend the money.
they figure out somewhere else to spend the money. And that's one of the, I mean, how you do this a lot. How often are you actually having people
Yeah.
do a 30-year loan and then changing it to a 20 or
Yeah.
a 15? It probably doesn't happen often. 8 out of 10 of your clients,
Yeah.
maybe.
I mean, it happens, but to your point, yeah, it's human nature that, people have a little bit of runway and that's their intention and they figure out some way to spend the money, whether it's, they decide their car is not as running as well as they hope and now they get a new car loan or, that is human nature. We see it. I would say that, yeah, my client and my personal experience is probably that 80-20 rule, that 80% probably don't fully realize it for whatever reason, whether they, get laid off or, there's a lot of different reasons why it doesn't happen. But yeah, I would say that's accurate. And that's one of the oppositions to the 50-year mortgage. And I kind of fall in this camp that, the way I see it is that it's a supply and demand kind of issue for me. So that, if say the 50, and this is how I see it playing out in my head is that, to your point, Wes, that if the 50-year loan were to be implemented today, let's say all of a sudden that opens the door for 20% more buyers, let's just say as example. So now we have, the amount of buyer demand increases by 20%. Well, we know we can just look at basic short-term history of even COVID that when buyer demand goes up, what happens to prices? Prices go up. You have more competition, more offers on the house, and so natural supply and demand says prices go up. So my fear is that even if the 50-year loan does help, make payments more affordable, those are going to be offset by higher prices, you know? So that's one of the opposition. I fear that that is the case that, even if it is more affordable, the prices are going to spike up because now supply and demand will push the prices up.
Well, and here's a question I have as well is what's really the difference between I think the prime right now is a little over 6, but you could get like a 6%
Mm,
right now.
yeah.
At a 50, you're probably looking at what, a 7%? Is it a point higher?
I mean, if you go from a 30 to a 15, generally rates are about 0.5%, 3/8 to 0.5% higher. So using that same kind of rationale, of course, we'd have to wait for it all to be fleshed out, but I would think the rates would be at least 0.5% higher. So if we're at 6% today, a 50-year might be at 6.5. And if I run those numbers, Wes, yeah, I think what you're going to allude to, that same scenario we talked about earlier, $400,000 loan amount on a 30-year at 6% versus a 50-year at 6.5%. The payment difference is only $143 a month.
So there you go. And that's I was going to ask you to run through an actual scenario. And I think that needs to be told to people. People need to be educated on this because when they hear 50, they hear cheaper homes. I can buy the house I want, but it's really not that much of a price difference. And here's the other thing.
No.
My opinion on real estate, one of the biggest reasons I'm in it is because I think it's one of it's the American dream. It's the way that anybody can really achieve wealth.
Yeah,
It starts by owning your home, right? And
sure.
so that really goes away when unless you buy a house in your 20s, right? Well, okay, it'll be paid off when you're 70.
Yeah,
At that point, are you really achieving wealth?
right.
And so for me, there's a big difference between a home being paid off in your 50s. If you bought a house at 20 years old, which most people don't even do that,
Right.
I'm curious.
Yeah, I mean, I think the average first-time homebuyer age as of this year's, I think it's 39.
It's 39. So if you're doing a 50-year mortgage, that house won't be paid off until you're 90, if you're even still alive at that point. And I know it sounds daunting, but I think people need to think about that of 39, 30 years is 69. Well, maybe you have 10, 15 years of rental property at that point, the cash flows because it's paid off.
Yeah.
And so, or you have no payment, which is another way to accumulate more wealth and pass that down to your family. So I think it's my job as a realtor to educate people on these topics
Yeah.
and really spell it out. And again, the difference in interest that you're just paying in 10 years is very, very, very different.
Yeah, and I feel that same responsibility, like, yeah, the 30-year loan has become that's kind of it's almost ingrained in the American dream at this point. It's been around for 70 years now that the 30-year fixed mortgage is just kind of part of the dream of home ownership. I mean, even then, 30-year paying off a home in 30 years that's a long time. If the average age is 40 years old, you're paying it off at 70, but there's more ways to do it. Like, just like I said earlier, where I don't see the 50-year loan ever being a long-term solution for a client. I believe that, and I think that's part of my job too. The average person owns a home for 7 years and then they sell it, so
They sell it.
they're never actually paying off or fully, going through the entire term, but that's part of
Well,
my job as a loan officer is
it's a good
educating
point.
as well.
Is there a strategy to that of, hey, it allows you to buy a cheaper home, and if you're not going to stay in it for more than 7 or 10 years, does it matter if you have a 50-year?
Yeah. Yeah, that's a conversation I have with clients all the time where, client bought at the peak of the market whenever, rates were at the highest, rates got up to over 7.5% for a short amount of time. So they are down quite a bit since then, but I have some clients that bought at the peak and they reach out to me, Trey, does it make sense to refinance? Well, my answer to them is always it depends. What is your long-term goals with this house? Do you plan to stay in it for the next 5+ years? Do you plan to sell it in 2 years because you're about to have kids go off to college and you're gonna downsize or you're building a family? And if there's always that's always a conversation to be had if, if you plan to stay in the property for only 2 more years, financing may not make sense because there is a break-even point, and, that's a conversation I have with all my clients. It's hard to predict sometimes how long you plan to stay in a property, but if you have some clarity on that, that's a big piece of the puzzle because very rarely, people are gonna stay in the house for the full, 20, 30, 50 years.
That's a great point. So the other side of this would be if that home, if you're staying, here's my opinion. If you're staying in the house long term, you don't plan on ever moving, 50
Yeah,
year might not make sense because you do a 30 for a few $100s more. You can make the argument if you're only going to be in it for a little bit to make your payments as cheap as possible with
yeah,
the 50. Now, I'm curious to if there's going to be kind of some terms on that, or does the 50-year term contingent on you have to live in that house for a certain amount of years, just like, yeah, they don't do that now,
yeah,
but
I
it
don't think
will.
so. Yeah, I personally don't think so because if this were to get fully implemented as a Fannie Mae backed loan, FHA backed loan, what happens behind the scenes in the mortgage world is once a loan's originated, those loans are then, bundled up and sold as mortgage backed securities. And so if this were to get implemented industry wide, they would already have all of that thought through and fully solidified on the secondary market. So there shouldn't be any sort of prepayment penalties or anything like that that would deter someone from doing a 50-year loan. It's really, to me, I really just think, and I think I mentioned it earlier, that I'm not really a strong for the 50-year loan, but I'm also not like a strong opposition to it. I just think it's simply gonna be another tool in the tool belt for me to offer my clients, and then, beyond that, it's incumbent on me to educate the client, figure out what's best for them, but, yeah, I don't see the 50-year loan ever being a long-term product. It would just simply be another tool in the tool belt. It's no different than right now in the non-QM space. I have the ability to offer interest-only loans. I have the ability to offer 40-year fixed loans. It wouldn't be much different to me than what I currently have to offer clients. It's just figuring out what are their goals, how long do they plan to stay in the property, and it's simply just another tool in the tool belt, I think.
Well, I think we've helped people kind of think through their. I mean, I think really the opinion is for you to figure out what makes sense for you. You've kind of heard the pros and cons on this call. I'm looking here. The average death age in America is 78 years old, and the average first home purchase is 39 years old.
Yeah.
Are the 50-year mortgages going to be a good thing for you? I think that's for you to decide, and hopefully this our job is to help bring that conversation to light, kind of hear the pros and cons, and so hopefully this cleared up a lot of confusion or questions for people out there. So Trey, how can people find you? What's the best way to reach out
Yeah.
if they want to purchase?
Yeah, for sure. So you can search first and last name, Trey, Trey, last name Belmore, B as in boy, Elmore. I'm with CMG Home Loans. My direct phone number, okay, should I give that out?
Hey, you can do whatever you want.
Direct phone number is 214-775595. Would happy to be connect with y'all, talk through the 50-year loan or any other questions you have. Yeah, would love to be a resource if I can.
Well, appreciate you guys. Thanks, Trey, for coming on. Y'all have a good one.
Appreciate you. All right, thanks.